Welcome to this video clip on sole proprietorship or sole traders. I'm Brendan Christian, director at Christian, the law firm. Sole proprietor or sole trader, what is that? A sole proprietor or sole trader is first and foremost a business. Secondly, unincorporated, which means it's not a company. Third, owned by one individual. And fourth, usually run by that individual also. To come straight to the point on this, I've got two big concerns with startups trading as sole proprietors or sole traders. My first big concern is around personal liability. From the get-go, from day one, you are putting up, exposing all of your personal assets to risk. It's a major risk to take. So if your startup fails, Lord forbid, but if your startup fails, you're going to have a very difficult and awkward conversation explaining to your life partner why it is that both of you and the kids are losing the family home and the family car, etc, etc. So that's my first issue with sole proprietorship. It's risk and more to the point, personal liability. Your personal assets from day one are up for grabs by your creditors should the startup fail. The second issue I have with sole proprietorship is around tax and the tax implications. And by this I mean, let's just take one jurisdiction. I mean, my firm works in a number of jurisdictions, so I'll just deal with one in this example. In England and Wales, income tax in the present climate, and when I say in the present climate, I'm now talking late December 2012. In the present climate, by way of income tax, and that's what you'll be liable for as a sole proprietor, income tax, it's a personal tax. If the startup succeeds, and let's just say, touch wood, all goes well, let's just say you're earning more than £50,000 per annum, the income tax rate would be about 40% of that. And remember, income tax is a tax on turnover. It's a tax on turnover. If you're earning as a sole proprietor in excess of £100,000 in the UK in the present climate, December 2012, you're looking at about 50% on turnover in excess of £100,000 by way of income tax. That's a big knock to take. Contrast that with a company. Let's just say you had chose to incorporate from day one, and so you had a private limited company. Same amounts of money now, £50,000 that the company made in its first year. Corporation tax, which the company is liable for. Corporation tax is only a tax on profits, unlike income tax, which is a tax on turnover. Corporation tax is a tax on profits. And so potentially on around £50,000, well, depending of course on what the profits were, remember, because we'll need to look at losses, etc, expenses and so forth. Depending on what the profits were, you're looking at about 23 to 25% tax on that. That's corporation tax on the profits. So I mean, you do the math, £50,000 being up for grabs, 40% tax, income tax, vis-a-vis a company, 23% tax, and it's only on the profits. It's not on turnover. That's corporation tax for you. So I mean, with those two considerations in mind, personal liability being the first and the tax implications, I'd say think long and hard before you start as a startup, as a sole proprietor. I'm Brendan Christian, the law firm. Thank you very much indeed.